Stocks selling off today as investors grow more concerned about a slowing economy. The Dow and S&P 500 turning their worst session of the year so far. And joining us now is Tom Lee from Fundstrat Global Advisors. He's also a CNBC contributor. And Tom, it is great to have you on a day like today where the major averages are not only lower on the day, they're lower on the week. And the Dow, the S&P, and the Nasdaq are now also lower on for the month of February so far. We teased it ahead of this conversation, the fact that you're seeing a contrarian bullish signal here. What is it?
Well, it's a couple things, but I'd say what really stands out to us is that the market has eluded extended periods of weakness because investors are bearish at the highs at a time when there's record cash on the sidelines. So to us, this is a market that is very skeptical of these new highs. That bearishness and concerns about tariffs means there's a wall of worry. So I think this is actually a very positive setup for stocks.
So you're not concerned about some of the data we've gotten? I mean, that University of Michigan consumer sentiment reading this morning in particular seems to have spooked investors, given the fact that it cited broad declines across age, income, wealth groups. You also said that big spike in year-ahead inflation expectations. That was unchanged, but the 5-year expectations moved higher, too. At what point does that start to manifest into something more meaningful in terms of a slowdown here in growth?
Well, these inflation expectation surveys matter to the Fed because they're concerned about whether or not consumers are actually raising their inflation expectations, and that would, in fact, be bad. But we have to keep in mind the UMich surveys do seem to be polluted by political affiliation. When you break down respondents by Democratic responses, they've gone from seeing inflation under 2% before the election to over 5% today. Republican respondents have gone from 4% to basically zero. In fact, if you look at the distribution of responses for those Democratic respondents, almost 7% think inflation is currently at 25%. So I think that there is a lot of pollution in that data, and I think it's probably pretty typical what happens when there is a change in administration, but I hope the Fed is aware of that political dynamic.
So, Tom, if I recall, in Q4 last year, you were warning about market turbulence, and we've been right now at around S&P 6,000. We're at the level where we were a month ago, a month before that, in late November. Should we also expect turbulence at these levels at this point, given that the macro narrative and the political landscape is still unclear?
It certainly seems like it. I mean, I think investors can cite a lot of things top of mind why short term they're expecting the turbulence. You know, we're coming off 2 back-to-back 20% years. We know there's significant uncertainty about tariffs. In our latest client survey, 63% of our clients, and that's over almost 2,000 respondents, said tariffs or deportations is the biggest risk. That's up from 54% last month. But these are not things that have necessarily long-term negative effects. In fact, things like the number of Fed cuts is actually back towards 2. And I think there's a possibility the Fed may actually make cuts sooner. I think one thing the market is being complacent on is thinking the Fed's on hold. But if this turbulence causes hiring to slow, I actually think the Fed could actually be making cuts a lot sooner, which would be positive for stocks.
Okay, so tell me about these granny shots that you've got, you know, part of your investing strategy, some specific stocks, especially since growthy stocks seem to be especially vulnerable on days like today. And if we're going to get more volatility, it sounds like we might get more days like today.
Yeah, that's possible. But investors really want to own stocks that actually have structural advantages. And that's best evidenced by revenue growth, margin expansion, earnings growth, and reasonable prices. So the reason growth stocks will still outperform is that in a period like this, if we have macro uncertainty, they're going to be names with some visibility. It's not pleasant to own a growth stock today, but you know we know the lesson of 2025 is that these pullbacks have not been deep and investors have been buying these dips. So I don't think today is any different. In fact, it's no different than the DeepSeek panic or the tariff day panic or the CPI panic. So, I think this is going to be a buying opportunity.
A recent cautionary note from Goldman Sachs expert Scott Rubner and a warning from analyst Tom Lee have captured the attention of investors around the globe. Could an impending tidal wave of market instability be looming just on the horizon? Rubner's insight comes as the daunting expiration of nearly $2.7 trillion in U.S. stock market derivatives approaches. Amongst the key players in this unfolding drama are financial giants like the S&P 500 and individual stocks threatened by the reverberations of this like Nvidia. But this is only the tip of the iceberg. Welcome back, everyone, to Investocracy.
It does seem like a pattern in 2025 as markets sort of take a hit on Fridays and maybe panic Monday. So I don't know if that's going to be the case. To me, I think the inflation headlines from UMich they're not great to see, but also I think that they are messed, or there's a political component to this, because if you break that down between Democrats who see 5% inflation and Republicans at zero, the blend is actually pushing this number up. But to me, it just gets messy around elections.
Yeah, but I mean, let's be honest. There are broad concerns about parts of this agenda from this White House, including, I might add, from the Fed, that it could be inflationary when rates are already more elevated than I think the Fed would like to see. They'd like to be able to cut more, but their hands are tied. And one of the reasons their hands are tied because of tariffs and unknowns about inflation. Fair?
That's fair. I'm not sure the UMich survey reflects their assessment necessarily of the tariffs as much as, let's say, the bond market. And the bond market seems less concerned about it because, as you know, yields have backed off from 4.8 towards 4.5. But you're right. Tariffs are a reason to be uncertain. But so far, I think if I looked at how markets reacted, I think they've actually taken them in stride.
I mean, your biggest takeaway thus far, you say, is that the market's proving resilient, which, I mean, let's be honest, too. Since the start of this bull market, it's been one heck of a resilient market. It's been able to deal with almost anything thrown in its face. You've had a couple of panic moments. Monday, off of the tariff news, last August, with the unwind of the carry trade, and then we just continue to set new highs.
That's right. And I think in 2025, a lot of investors thought maybe the playbook would change because we just put 20% years behind us. But I think with January being up 2.7%, and I think these sell-offs being bought, it does feel like the same market that we had last year.
What are you worried about?
Well, I'm worried about sentiment becoming too bullish, but actually
bullish?
But it's turned the other way. Sentiment actually has weakened pretty meaningfully. And I'd worry about a policy error from the Fed. And as you know, the bond market still thinks there's more than a 20% chance the Fed hikes this year. I think it would be obviously a policy error if they raise rates.
What about a policy error from the White House?
That's also something markets worry about, yes. But so far, I would say that the news that we've seen on tariffs, they've had more bark than bite, meaning they've proven to be opportunities for investors to buy.
Scott Rubner of Goldman Sachs has stirred the waters with his forecast of market volatility linked to the expiration of approximately $2.7 trillion in derivatives. The potential consequences of these lapsed contracts weigh heavily on the minds of investors. Rubner, along with other financial savants like Dan Izzo, believes that if investors shy away from renewing their options bets, the resulting vacuum could usher in severe market tremors. But before going on with the video, are you into cryptocurrency? If so, check out our second channel, Investocracy Crypto. We bring you breaking news, expert analysis, and the latest trends in the fast-moving world of digital assets. Whether you're a seasoned crypto investor or just curious about the future of finance, we've got something for you. Click the link in the description to subscribe to Investocracy Crypto now. Don't miss out and stay ahead of the game. Now, let's get back to the video.
I don't know that there's a stock in the market that has higher expectations than Nvidia, which always does, and it's going to again next week, and maybe the stakes are higher given the way we're ending this one.
Well, that's true. They are higher, and everybody will be looking at Nvidia as sort of the harbinger of where AI is going. But we'll see. I mean, Elon Musk just spent quite a bit of money on thousands of Nvidia chips that he put together, and within a few weeks or maybe months, they put together a large language model, which is very competitive with the other ones. I think the fact that we've got everybody scrambling to build the next best large language model, and every week we seem to have another one, I think that's great progress in terms of what the users of this technology are going to be able to do with it. I think that that's already happening. So yeah, I think NVIDIA is very important, but so are 493 other stocks besides the Magnificent Seven, and I think they're going to continue to crank out better and better earnings.
These contracts encompass bets on heavy hitters like the S&P 500, key U.S. exchange-traded funds, and individual stocks, all coalescing into a financial mosaic that brokers and banks, holding over $9 billion in hedges, struggle to keep stable. Dan Izzo paints a picture of potential chaos, noting that the reluctance to assume this risk could snowball into a broader market downturn. A powerful warning echoing through the stock market corridors. But before going any further, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
Nvidia specifically, I think the expectations are still quite high, and the stock is up 100% in the past year, and everybody owns it, probably except me. But the expectations are high, and I don't know if they're going to raise numbers as aggressively as they did, and they have been doing over the past year. I don't think it's going to fall off a cliff. And you mentioned the hyperscalers. The hyperscalers aren't cutting back. They're increasing the numbers, right?
Up.
So that does help them. I just think the expectations are really high. So I think, wouldn't be surprised as the options market is pricing an 8% move either way. I don't think that's a really big deal, considering how much the stock has actually run up. But I would wait, in terms of buying other semiconductors, I would wait until they report.
How big of a moment is this for the market next week as it goes into a new week a bit unsettled?
Yeah, we think it is still a very important moment simply because it has such a large weight in the indices and it encapsulates the hope of all of the AI trade. And looking at the technicals of Nvidia, it's not all too inspiring in the very short term. If 125 doesn't hold, we do think you could see something closer to 100. That's very normal for Nvidia to experience that kind of volatility. But that kind of volatility is something that the market has not been used to over the last couple of years since we've been in this very powerful up and to the right, low volatility kind of trading.
The stock was just back at 145. Yeah. So in the momentum pullback and as tech had just started to reawaken, and now these stocks are selling off a bit, almost across the board. You can go down all of the Mag 7 names are certainly down today, and the only one that's positive on the week is Microsoft, and that's by this much.
The looming energy surrounding the expiration of $2.7 trillion in derivatives unveils both danger and opportunity. The dual-edged nature of investment horizons. With strategic insight and cautious optimism, the daredevils of Wall Street may find it an opportune moment to secure their stakes in the financial realm for potentially massive returns. But what do you think? Share your thoughts. Finally, if you would like to know what companies like Nvidia have been up to these past few days, go ahead and click on the next video on your screen. See you there.